let's look at the factors impacting equity market in short term, medium term and long term. In short term, market movement is influenced by the news and events. In medium term, the corporate profitability defines the market movement. And in longer period of time, the broad economic factor decides the market movement. And hence, all three are important for you as an investor. So therefore, the time is very essential in the market. So let's look at all three factors one by one. So let's look at short-term view. And we all have seen that since October 18, market has been corrected by 15%. We were about 18,477 level in October 2021 and today about 15,780, which means a fall about 15%, right? So is it happening for the first time, this kind of a correction? Let's look at the past data. And hence we have seen the last 20 years data and we have picked up the highest fall for last 20 years, which means now we have 20 data points and the average of these 20 falls has been 20.3%. The one more important data that we've observed here is how much time every fall has taken to come back to the original level, right? And if you see this data, out of 20 data, 30% times it has taken less than 3 months time to come back to the original level, right? In 3 months to 6 months, there are 15% time it has come back in 3 months to 6 months. 25% time it has come back to 6 months to 9 months time, and 5% time it has taken 9 months to 1 year, which means 75% instances market has recovered in less than 12 months. So two things what we have seen here is that such kind of a fall is not new. It has happened every year in the past 20 years and average recovery period is about 1 year, less than 1 year for 75% instances. That's one thing, right? So you as an investor now, what you should do, right? So today, is there an opportunity for you? From 18,477, we're at 15,780 levels, right? Which is fall about 15%. And if you have seen the probability of 3 months, 6 months and 9 months, right? If you see, if the market goes up to the original level in next 3 months time, which is 15,780 to 18,477, which means the returns, annualized returns about 87%, which will be getting in next 3 months time. And the probability of that is about 30%. And likewise, if you see the highest probability is about if the market goes up to the original level in next 1 year's time, it will record about 17% returns for you as an investor. And for that, the probability is about 75%. And hence today, do you see opportunity? I think you can invest today and you can see returns about 17% in next 1 year's time with the past data. Let's take a medium term view. As I mentioned earlier, in the medium term, corporate profitability defined the movement of the market, right? And one of the indicator of corporate profitability is the earning per share. So here is the data of Nifty 50 companies for last FY21 and FY22. So earning per share of Nifty 50 companies in 21 stood at 518. And from there, if you notice in 22, which is the year we just passed by, the earning per share went up to 774. Which means they have recorded about 49% growth, which is one of the highest growth that we have seen as far as the earning per share of Nifty 50 companies is concerned. And this data is really, really healthy from the market point of view. That's one. Looking at the earning per share for the next year and next to next year. So here is an estimation, our estimation that last year earning per share stood at 774. This financial year 22-23, we expect it to reach to about 867, which means a growth of 12%. And the next year, we expect it to reach about 971, additional growth of 12%. So why are we saying 12% growth? We all know that our GDP, Indian GDP is one of the fastest growing GDP and we expect it to grow about 7%. So past data suggests that the corporate have been growing about additional 5% than the GDP and hence we believe 12% growth is a very reasonable growth in spite of having this 49% growth that we recorded last year. So with these two data which suggests that we're growing about 12% this year and next to next year, again these two suggest that the earning per share of Nifty 50 companies will be very healthy in coming 2 years. So with these two data that we've seen, earning per share for last year and next 2 years, where should be the market be at this point of time? And for you as an investor, you have to look at it whether the market is overvalued, undervalued or reasonable valued. To define this, whether we have a froth in the market, let's see how much is the froth in the market today. So how do we calculate froth, right? So the best way to calculate is look at the current value of Nifty minus the reasonable value of Nifty. Now we all know what is the current value of Nifty. We're at 15,780 level, right? What is reasonable value of Nifty? So reasonable value of Nifty is nothing but the earning per share of Nifty 50 companies, let's say 1 year down the line. Now why are we saying 1 year down the line? Because market looks at future. I'll give you a simple example. In 2020, when the market corrected in March 20, it did not correct mainly because of the earning per share has hampered in 2020 March. It saw that we're approaching pandemic and hence the corporate earnings in the next financial year will get affected and hence market got corrected. So today, if you have to look at it, the reasonable value of Nifty, we have to look at it, the earning per share of next year, which is 20 to 23, right? So earning per share of 20 to 23 multiply by reasonable PE. What is reasonable PE? PE means how many times the market is of the earnings, right? So earning per share of 2023 multiply by how many times it is, right? So let's take an example. Current Nifty level at 15,780, right? Expected earning per share 20 to 23, which I just shared with you, is about 867. If you multiply that by 19, now why are we saying 19? Because the past data suggests that it has been 18 times. But considering fact that we are a low interest regime, it is reasonable to take 19, right? So if you multiply 867 by 19, the reasonable level Nifty comes to 16,473. And where are we today? 15,780, which means we are already 693 points below the reasonable level of Nifty, which is negative 4% froth that we're having today. So that is one important factor that you should know as an investor, that this level of Nifty is below the reasonable level of Nifty, what it should be, right? So if you look at it, the where Nifty should be 1 year down the line, right? Today, if you have seen the Nifty level, reasonable level of Nifty basis the 1 year forward earnings. So if you have to look at the Nifty level next year, which is June 2023, you have to look at the earning per share of 2324. So with the same calculation, if you look at the current level of Nifty 15,780, expected earning of 2324, as I shared with you earlier, is 971. So if you multiply that by the reasonable P 19, the reasonable level of Nifty should be 18,449 in 1 year down the line, which is June 2023, which means we are 2,600 points below that level as of today. In other words, it's a negative froth of 17%. So you as an investor, if you have to look at it today's level of Nifty, and while making investment, let's say you take a horizon for 1 year, 2 year, 3 year, let's say you have a 1 year horizon of Nifty, right? If you see where Nifty should be, it should be at 18,449. Where are we today? At 15,780. What is the gap? 17%, which clearly indicates that Nifty is supposed to or deliver about 17% returns. And if your portfolio into mutual funds, if they add about a couple of percent alpha over Nifty, it is expected to deliver about 18-19% in next 1 year. So that's our medium term view for the market. Let's take a long term view. The main indicator for long term view is GDP growth. And we all know that we have grown by about 8.7% in last financial year, that is 21-22. And if you look at the forecast by RBI, World Bank, Fitch, and if you consider the lowest amongst them, which is RBI, we are expected to grow about 7.2%. So if you're considering these two data points, 8.7 which have grown last year and 7.2 which will grow in this financial year, this is way above the long-term average of 5.8%. That's a long-term average of GDP growth. And this clearly suggests that India continues to be in the growth phase. That is one important factor that we should look at it. The second thing what we should look at is tax collection. So coming to tax collection, if you look at direct tax and indirect tax, so direct tax is nothing but the individual tax and the corporate tax, and indirect tax is the GST. So if you look at the last year data, 21-22, direct tax collection actually went up by 50%, the indirect tax collection went up by about 20%, and overall tax collection went up by about 34%, right? That is last year 21-22, and the trend continues in this financial year as well. So if you look at the first quarter, direct tax collection went up by 45%, indirect tax collection went up by 35%. So what it indicates? Direct tax collection indicates it's a sign of the increased sales and the increased growth in the corporate profitability. The indirect tax collection, which is GST, indicates that there is an increased economic activity. So this data is also very, very important. right? Because GDP number comes at the end of the year, but this data, if we continue to track, this indicates that the growth of GDP is in line or no. So this data also suggests that our economy is in line with the growth that we're expecting. Let's take an update on inflation and interest rate. So if you look at the current inflation, it is about 7%, and it is now higher than the 10 years average, which is long-term average of 6.3%. Now, what RBI is expecting in this financial year? RBI has revised this year inflation from 5.7% to 6.7%, and RBI is expecting that it will remain in the reasonable level going forward in a couple of years as well, right? The immediate impact of this high inflation, which is obviously on account of the high commodity prices, is on the interest rate. So now what has happened this financial year is that because of the high inflation, the 10-year GSEC has now moved to 7.45%, and which is very close to now 10-year average of 7.5%. Right? So as I mentioned, RBI is expecting it to remain in the reasonable range, and hence the interest rate, the 10-year GSEC also will be lower than the long-term average. That's what we are expecting, and if that happens, it is definitely conducive for the bull run. So now let's look at the data on the fiscal deficit. So what is fiscal deficit for this financial year? Government has projected it will be about 6.4%. Right? So let's see what has happened last financial year. So last financial year, government expected the revenue receipts about 20,78,000 crore. But what actually happened? What they actually collected about 21,68,000 crores. And this financial year, government's expectations about revenue receipts is about 22,03,000 crore, which means just 1.6% higher than what we collected last financial year. So our estimate is that if GDP growth is about 7%, the revenue receipts can be reasonable. If you consider about 10% growth, we can easily estimate. So if the revenue receipt goes up by 10% on 22,03,000 crore, I think the government can expect about 23,68,000 crore revenue receipt. And if that happens, what will happen is that government will have a lesser pressure on the borrowings. So the borrowings about 11,19,000 crores can come down to 8,26,000 crore. So therefore, this excess revenue which government is expecting or may get, the couple of things what government can do. They can borrow less, they can increase the capital expenditure, and they can also reduce taxes on certain commodities like petroleum just to curb the inflation. So if that happens, I think the takeaway from this is that fiscal deficit will reduce, the inflation will remain in the reasonable range, and the impact of that on the interest rate, it will be lower than the long-term average, right? So that's our view on the long term. So what you should do as an investor. So if you're invested into market, I think you should stay invested, and every opportunity, every correction, you should look at as an opportunity and fill up the gap in your portfolio. And do you need any help, you can contact the Airwell partner.